Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss the seasonal ideas for Bitcoin and Ethereum trading, halvings and forks.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today I would like to discuss seasonal trading ideas for cryptocurrencies. I already mentioned it in my previous videos. In Quantpedia, we are really fond of seasonal and calendar trading anomalies. The reason for that is because they are very often easy to execute and they have interesting performance, plus they are very often really robust. We are trying to find seasonal anomalies not just in usual asset classes like equities, bonds, commodities, but we also like to take a look on new assets like cryptocurrencies. In today's video, we will discuss what are the interesting events that we can use to trade in cryptocurrencies, and we will speak about the Bitcoin and Ethereum events. I will not discuss very deeply what are the cryptocurrencies. I think that everybody who is working in the finance or is interested in the finance already know how the cryptocurrencies work. So what we are trying to achieve and show in this video is that we can find inspiration in academic research. There are a lot of seasonal and calendar trading anomalies that are related to different events. It can be, for example, option expirations. It can be Fed decisions, turn on demand, various releases of economic statements like CPI, so inflation, PPI, industrial production, etc., etc. We already covered a lot of them. What we are trying to find out is what are some of the events that are really specific for cryptocurrencies. The first event that's really specific to cryptocurrencies is Bitcoin halving. What is the Bitcoin halving? There is one important feature which is pre-programmed in the source code of the Bitcoin. So the reward that the miners receive for including transactions into block is not the permanent, but every 110,000 blocks that are mined, the block reward is halved. So this event occurs approximately every 4 years. So far we had 3 big events or 3 big halvings. First one was in 2012, then in 2016, and the last in 2020, and we can expect another one in 2024. Now the question is, what is the price action around those halvings, around those events? So we downloaded the data and we did a very quick event analysis. What we can see from the chart, we can check the average black curve, which is the average price action around the Bitcoin halving event. So what we can see is that there is a distinct pattern. Firstly, slightly goes down. The minimum price is around 10 days before the halving, and then it usually appreciate until the halving. After the halving, the price action is not significant. There are not a lot of events, so we cannot draw very strong conclusions, but we can see that definitely before the halving, the volatility on Bitcoin is significantly higher than after the halving, so after the event. We have only 3 events, so it's really risky to draw very strong conclusions, but we can learn something from that. The second event that we try to study are soft and hard forks. What are the soft and hard forks and what is the difference? So hard forks, backward incompatible software updates. Typically this occurs when the node in a blockchain add new rules in a way that conflicts with the rules of the old node. So then it means that new nodes can only communicate with the others that operate also the new version of the protocol, and as a result the blockchain splits. So we have 2 separate networks, we have 2 separate coins, one with the old rules and the one with the new rules. So that's a hard fork. So when there is a hard fork, coin usually splits and we have 2 different coins. So it happened, for example, with the Bitcoin. We have an original Bitcoin and we have Bitcoin Gold. Try to start the same with the Ethereum. So we have a classic Ethereum, Ethereum Gold, etc. So we have like multiple different coins after the hard fork. Soft forks is a backward compatible upgrade, so it means it's only the upgrade. Some of the nodes are upgraded, others are not, but all the nodes can still communicate with the non-upgraded ones. So it usually happens when there is a new rule that doesn't clash with the older rules. So what we try to do is that we try to create a list of all Bitcoin and Ethereum forks, hard and soft forks, and we created the table and we checked what is the price action around these hard and soft forks. Here is a table plus a chart with the price action around the Bitcoin forks. What we can see is again a significant price action. So there is a significant price appreciation on average before the fork. There is not a very significant price action after the fork. Once again, the volatility before and after the event is significant. So yeah, on average, there is significant performance that can be gained by going long before the fork. but the volatility is also significant. So there can be events when there can be significant drawdown before the fork. Even that on average we can expect price appreciation before the fork. So that's how does it look like on Bitcoin. Let's move to Ethereum. So for Ethereum, we also went through multiple websites and we tried to put together a list with all of the soft and hard forks. And then we again performed event analysis. So what we can see in Ethereum is once again on average, the black line, there is a price appreciation before the fork. There is also price appreciation after the fork. What is the difference compared to Bitcoin is that the volatility before and after the fork is even higher than in case of the Bitcoin. I'm trying to trade these events, the forks, is not without the risk. So yeah, it is possible to earn some money. Yeah, on average, before the fork there is a price appreciation. Also after the fork there is a price appreciation. It's not small. It's like 20% over the 30 days after the fork and 10% over the 30 days before the fork, but the volatility is really, really high. Our short conclusion would be that events that are related to changes in cryptocurrency algorithms can give market participants interesting trading and investing opportunities. Yeah, that's right. We really would like to say that be cautious here. Firstly, we do not have a long sample of events because the cryptocurrency market is young, so we don't have enough events, especially in the case of Bitcoin halving. And additionally, tables and charts indicate the dispersion in the performance before and after the events is really, really significant. So yeah, we can use the results as a guide for tactically building long-term positions to the long side. But if you would like to trade those events independently, really be cautious because the noise around the events is really high. So thank you very much. I hope that you like this video, and I hope that you join me in the next. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.